You know that feeling? You want to really understand some financial thing, but you're just hit with this wall of jargon.
Yeah, information overload is real.
Exactly. So we're trying to cut through that today. We're doing a deep dive, nice and simple, into covered call ETFs in Canada.
Right, these are tools some Canadians are using, aiming for regular income from investments,
Yeah.
especially potentially inside a TFSA.
Think of this as maybe your quick guide to figuring out if this whole covered call thing could actually be something useful for you.
Yeah, that's the plan. We've looked into how they work, trying to pull out the core stuff.
So, simple terms, real examples, and making it actionable, particularly for Canadian investors and that TFSA angle.
Precisely. Let's make sense of it.
Okay, let's dive in then. Covered call ETFs. Sounds a bit technical, maybe.
It can sound that way, yeah.
But the basic idea is actually, pretty straightforward. Let's say you own some stocks, right? Some Canadian companies, maybe.
Okay.
Think of owning those shares like owning, I don't know, a house you rent out.
Okay, like a rental property. I like that analogy.
Yeah. Now, what if you could basically offer someone the option to buy that house from you later at a set price,
Uh-huh.
and they pay you a little bit of money today just for that option? You still own the house for now, right?
Right, you still own it.
And you pocketed some extra cash.
That's actually a really good way to picture it. A covered call ETF does something similar, but, with stocks.
Right.
So the ETF itself, it owns a bunch of stocks like any normal ETF.
Mm.
But then the fund manager takes it a step further. They sell these options on some of those stocks.
The calls.
The calls, exactly. Covered calls. It's like they're saying, hey, someone else can have the right, not the obligation, but the right to buy these specific shares from us at a certain price, the strike price, sometime in the near future.
And just for giving someone that right?
They get paid. The ETF collects money up front. That's called the premium.
Ah, okay. And that premium, that's where the potential monthly income comes from that people talk about.
That's the core of it, yeah. That premium income is the main goal of the strategy.
It's like getting rent from your stocks each month, almost.
In a way, let's use a quick example from the materials. Say the ETF owns 100 shares of XYZ Corp, trading at $50.
Right. Wow.
The manager might sell a call option, giving someone the right to buy those shares at, say, $52 within the next month.
Right.
And for selling that option, maybe they collect $1 per share. So that's $100 cash right into the ETF.
$100 premium. Got it. So the month goes by. What happens next? Walk us through the simple outcomes.
Sure. Two main possibilities. First, the stock price stays below $52. Maybe it goes to $51. Maybe it even drops a bit.
Huh?
In that case, the option is out of the money. Nobody wants to buy at $52 if they can buy cheaper on the market, so the option just expires. Worthless.
Okay, so the option disappears.
Right. And the ETF, it keeps the
Okay.
original 100 shares of stock, and it keeps the $100 premium it collected earlier. Win-win in that scenario.
Okay, kept the investment, made a little extra cash. Nice. What's the other path?
The other path is the stock price goes above $52. Let's say it jumps to $55. Now, that option holder is happy. They have the right to buy at $52, even though the market price is $55. They'll likely exercise the option,
Meaning the ETF has to sell.
meaning the ETF is obligated to sell those 100 shares at the agreed $52 price. They get $5,200 for the shares.
Even though they're worth $5,500 on the market.
Correct. That's the trade-off. But, and this is key, the ETF still keeps that $100 premium they got at the beginning.
Ah, right. So they made the $52 per share plus the $1 premium per share.
Exactly. Their total proceeds are effectively $53 per share in this case. $52 in sale plus $1 premium. And often, the fund manager just repeats this process, selling new options month after month, aiming for that steady stream of premium income.
Which leads to those monthly distributions people look for. Okay, I think I get the mechanics now. So why should you, the listener, care? What are the actual benefits here?
Well, the big one, the headline, is definitely that potential for monthly income.
Right.
That regular cash flow, it can be really appealing. Maybe you want extra spending money. Maybe you're nearing retirement. Or maybe you just want to reinvest it.
And you mentioned the TFSA angle. That's pretty significant for Canadians, isn't it?
Hugely significant. Earning that income inside a tax-free savings account means potentially it's completely tax-free. No tax hit on those monthly payouts. That's a powerful advantage.
Tax-free monthly income definitely sounds good. Okay, what else? We heard they might have lower volatility. How does that work?
Yeah, the idea is that the premium income acts like a small buffer or a cushion.
Okay.
If the underlying stocks dip a little bit in value, the income you received from selling the option can help offset some of that loss. It makes the ride potentially a bit smoother than just holding the stocks directly.
So it doesn't prevent big drops, but softens the smaller bumps.
Exactly. Think of it like a small insurance premium you receive, just in case. It won't cover a catastrophe, but helps with minor dings.
Gotcha. And another point was that they can be good for sideways markets. Explain that one.
Sure. So imagine the stock market isn't really roaring ahead, but it's not crashing either. It's just kind of flat, drifting sideways.
Yeah, happens often enough.
Right. In that kind of environment, just holding stocks might not give you much return. But with a covered call strategy, you're still selling those options month after month.
Ah, so you're still potentially generating that premium income.
Precisely. Even if the stocks aren't going up much, the option selling can still provide a return. So it offers a way to potentially earn something even when the market's not cooperating on the growth front.
Okay, so income potential, potentially smoother ride, works okay in flat markets, and the big TFSA tax advantage. It sounds pretty good, but there have to be downsides, right? What are the trade-offs?
Oh, absolutely. There are definitely trade-offs. The big one you have to understand is limited upside potential.
Limited upside, meaning
Meaning, by selling that call option, you're essentially agreeing to sell your shares if they hit a certain price.
the strike price, like $52 in our example.
Exactly. If that stock suddenly skyrockets to $60 or $70, well, you might be forced to sell at $52. You miss out on those extra gains above the strike price.
So you're capping your potential profit if the stock really takes off, like agreeing to sell your house for a fixed price, even if the neighborhood suddenly booms.
That's a perfect analogy. You get the premium income, but you give up some potential for those big outsized gains.
Which leads to the next point, right, that these are not ideal in strong bull markets.
Correct, for the same reason. When the market is consistently and rapidly moving upwards, just holding the stocks directly, or in a plain index ETF, will likely give you a much higher return.
Because you're not capping your gains.
Exactly. The Covered Call ETF will participate, it will go up, but likely lag behind because it keeps having its winners called away at those lower strike prices. You're trading potential growth for income.
Okay, that's a critical trade-off to grasp. Income versus growth potential. Now, something called return of capital, ROC, was mentioned. What is that about? Is it bad?
Yeah, ROC. It sounds a bit complicated, but basically, sometimes part of the monthly distribution you get isn't actually profit or income earned by the ETF.
It's not profit.
It can sometimes be, literally, return of your own invested capital, your own money coming back to you.
Huh. Why does that happen?
It's often due to accounting rules and how option premiums or capital losses are handled within the fund structure. Now, in a TFSA, it often doesn't make a huge difference immediately because there are no tax implications.
Right. Tax-free account.
But in a non-registered account, that return of capital reduces your adjusted cost base, basically, what you paid for the investment for tax purposes.
Which means?
Which means when you eventually sell the ETF, your taxable capital gain could be larger because your starting cost is considered lower. So it's not necessarily bad, but it's definitely not the same as pure income or dividends and has tax implications outside registered accounts. Something to be aware of.
Good to know. Need to look at the distribution breakdown. And finally, fees. Are they more expensive?
Generally, yes. Managing the option strategy, deciding which options to sell when, at what price, it's more active work than just tracking an index.
Makes sense.
So the management fees, the MER or management expense ratio, tend to be higher. We saw figures mentioned around, say, 0.65% to 0.75% annually.
Compared to basic index ETFs, which can be, what, below 0.10% sometimes?
Exactly. So it's a noticeable difference. You're paying for that active options management and the potential income generation. It's part of the cost of the strategy.
Okay, so we know how they work, the pros, the cons. Let's get practical. What are some actual examples of these ETFs that Canadians can, look up?
Sure. There are quite a few now. A popular one that often comes up is the BMO Covered Call Canadian Banks ETF. The ticker is ZWB.
ZWB. Okay, thanks.
Yeah, holds the big Canadian banks, sells calls on them. It's generally seen as aiming for stable income from a pretty stable sector in Canada. Yields mentioned were often in that 7% to 8% range, though that can fluctuate, of course.
Okay, so ZWB for bank exposure with income focus. What else?
BMO also has a Covered Call Utilities ETF. Utilities, telecoms again, generally seen as more defensive sectors. Similar idea, aiming for income and maybe a bit less volatility.
Makes sense. Any that focus outside Canada.
Yep. There's the Hamilton Enhanced U.S. Covered Call ETF that gives you U.S. market exposure using the covered call strategy. Often aims for a higher yield, maybe using slightly more aggressive option writing.
Higher yield might mean higher risk, though.
Potentially, yes. Depends on the underlying holdings and the specifics of the option strategy.
Yeah.
Then you've got providers like Horizons with their enhanced income ETFs. They have sector-specific ones like HEX for energy,
Okay.
HHL for healthcare, HEP for pipelines. These are obviously more concentrated bets on specific industries aiming for high income from those sectors.
So higher potential reward maybe, but also concentrated sector risk.
Definitely. And CI Financial also has a range of covered call ETFs, often sector-based too, like tech or financials, using similar strategies.
So lots of choices covering different markets and sectors.
There really are. And remember, you can buy these typically in any account, TFSA or RRSP, non-registered. But as we keep saying, the TFSA is often highlighted as the sweet spot for that tax-free income.
Right. Okay. Brings us to the big question for you listening.
Hmm.
Is this actually right for you? How do you decide?
Well, let's try some maybe yes and maybe no scenarios.
Good idea.
You might consider these if, number one, generating that monthly income is a really high priority for you.
Like for retirement income.
Exactly. Or if you're just looking to supplement cash flow. Also, if you think the market might be kind of flat or only grow moderately for a while, the income aspect becomes more attractive relative to pure growth.
Okay.
And maybe if you want to diversify your portfolio by adding something specifically designed for income generation, potentially with lower volatility.
All right, so income focus, nearing retirement, expecting flat markets, diversification, those are the maybe yes flags. What about the maybe no's?
These might not be the best fit if your main goal is maximum long-term growth.
Like if you're young and accumulating wealth.
Right, if you've got decades before you need the money, you might prioritize capital appreciation. And that capped upside on covered calls could hold you back, especially in strong markets.
Makes sense. Give up income now for potentially more growth later.
Also, if you're just not comfortable with strategies involving options, even if the manager handles it, if you prefer pure, simple stock or bond ownership, these add a layer of complexity you might not want.
Fair enough. Comfort level matters too.
Absolutely. It really comes down to aligning the tool with your specific goals and your tolerance for the trade-offs involved.
So it really boils down to that personal assessment. Income now versus potential growth later. Comfort with the strategy.
That's the heart of it. Covered calls are a specific tool for a specific job primarily, generating income while holding stocks. The TFSA makes that income potentially tax-free, which is a big plus in Canada.
But you have to weigh that against giving up some potential upside, especially if the market goes on a tear.
Exactly. Understand the benefits income, potential volatility reduction. Understand the trade-offs, capped gains, potentially lagging in bull markets, slightly higher fees. Then see how it fits your picture.
Okay, let's wrap this up. Key takeaways for everyone listening to our deep dive today.
I'd say number one, covered call ETFs are designed primarily to generate regular income from stocks by selling options.
Income focus. Got it.
Number two, in Canada, putting them in a TFSA can make that income tax-free, which is a major advantage.
TFSA power. Yes.
Number three, this income comes with a trade-off. You potentially limit your upside if stocks rise sharply. You won't capture all the gains in a strong bull market.
The capped gains. Crucial point.
And finally, like any investment, really think about your own financial goals, your timeline, and your comfort level with risk and complexity before deciding if these fit into your portfolio.
Excellent summary. Thanks for making covered call ETFs feel a lot less intimidating. Hopefully this gives you a much clearer picture.
I hope so too. And, maybe take a closer look at some of those tickers we mentioned, or search for others based on sectors you're interested in. Do your own homework, of course.
Always. Okay, one final thought for you to chew on as we finish up. Could adding an income strategy like covered calls actually help you create a more balanced portfolio overall? Balancing maybe current income needs with future growth goals? How might that shift your thinking?
Interesting question to ponder.
Something to think about. Thanks for joining us for this deep dive, and we'll catch you on the next one.